and altcoins, and the fact that we're seeing the usual of people getting wrecked while longing Bitcoin and alts in the supposed market. As you know, there's no bull markets and bear markets. There's buy pressure and sell pressure. And sometimes there's an extended period of time for that buy pressure and extended sell pressure. That's all there is. But to make it easy for the average person, the marketeers of this industry call it bull markets and bear markets to make it sound catchy and headline grabbing and all that kind of stuff, which I understand. I have marketed this industry for many years, many years ago. I understand how that goes. But the fact is, traders, right, specifically retail traders, typically are making trades in the wrong way, right? And they're getting wrecked. And very often, they're literally getting wrecked, longing assets in a supposed bull market, because greed gets the better of them, and they think, oh, it's going up, I got to get in now because it's going to keep going up. And then it turns around, and because they're massively over leveraged, like 20, 30, 40, 50x, sometimes more, if it makes a little move just to the downside a little bit, they get wrecked. And we see that happen all the time. Even if you use fairly light leverage, 2, 3x, or maybe you're a little bit risky, you go to 4 or 5x, it's still entirely possible to get wrecked, because we see 20% moves in altcoins and Bitcoin pretty quickly on a regular basis. Sometimes it takes minutes, sometimes hours, sometimes days, sometimes a couple weeks, but a 20% move, even a 30 or 40% move, it's not impossible, right? Back in, what was it, June? April, May, June, sometime around then, Bitcoin was down. It was $70,000 something. That's well more than 30%. So if you'd been shorting when it bottomed out there, and then you held that short all the way up on the way up now, you've been wrecked. If you were 20x or whatever, you were wrecked a long time ago. Even if you were 5x, even if you were 3x, you were wrecked a long time ago. So the point is, people get wrecked to the long and to the short, right? Upside and downside, every day, constantly. Just look at the CoinGlass, for example. CoinGlass website shows you liquidations, right, as they happen across a whole bunch of different popular crypto exchanges, like Binance and I guess Coinbase or whatever. They have a bunch of them on there. I forget which ones are on there, but they track like some of the top, crypto exchanges, and they show you every time someone gets wrecked. And you see the average amount people get wrecked is around $3,000. That's on average. It's not a mistake. It's not by coincidence. And that's because the average deposit tends to be around $5,000 for first-time depositors. And typically those first-time depositors are going to get wrecked within 90 days. Right? The expression is 90% of traders lose 90% of their capital within 90 days. But to be honest, in crypto, given that you have so much more leverage and so many fewer safeguards than you have in traditional trading platforms, that really it's more like 99% of traders get wrecked, not lose 90% of their capital, get wrecked, as in lose 100% of their trading capital in their account within like 60 days. Because it's much faster and they have a lot more leverage that they can use, which is really just like dynamite in the hands of a clueless person. They don't know what leverage is. They don't know how it works. And when they try it, it's very scary. And when they're not familiar with closing trades at a minimal loss, it's easy for them to get wrecked because the position can slip away from them, put them in a position where they think, oh God, this is too, I can't do this. I got to wait longer for it to get better. And then when it doesn't get better, eventually it goes to a place where they get wrecked because they refuse to get out along the way. Sometimes it's better to cut your losses and start over with a smaller account size, but still something. So what happens is sometimes they get wrecked on a small trade, or sometimes they pull out, and they do it over and over again. And after a few trades, yeah, they'll lose a few $1,000 on a single trade. That's why the average trade out of all the hundreds of thousands of traders, anywhere from you'll typically see on a slow day, 50,000 traders got wrecked, and on a fairly busy day, 250,000 people got wrecked across just the crypto exchanges. Think about that. That's insane, right? We're talking anywhere from a decent sized town or city to a fairly sizable one, not a massive one or anything, but definitely can have, hundreds of thousands of people getting wrecked in a given day just on a small handful of the major exchanges. And they'll typically lose on average around $3,000 a piece. Yeah, sometimes it's as little as 2, sometimes as much as 4 or 5, but 3,000 is right there your sweet spot. And yes, of course, you'll have the occasional big losers who lose 10K, 50K, 100K, $1 million, $10 million. These things happen. But the exchanges, they don't make their money on those guys, really. They make their money on the ever constant, non-stop grinding away of the machine, taking away the $2,000, $3,000 accounts. That's where they make their bread and butter. For every one of those that they liquidate, if the exchange itself isn't the other side of the trade, which in most cases it is, if they're not themselves the other side of the trade, they still make money on the fees. The trading fees, the liquidation fees, etc., right? So they make money either way. And since they are very often the other side of the trade, right, especially on B-Book exchanges, which is what most of these places are. Hello to you. Hello. Since they are B-Book exchanges, they are literally allowed to trade against you if you're trading on them. And guess what? They do trade against you. They know exactly where your pain points are, especially if you use stop losses. I know you'll tell me, what are we talking about? Stop losses are important. You have to have stop losses. No, you need to be your own stop loss, and you need to pull out when you're losing and not wait for the system to do it for you automatically, because the system very often will fail. And when I say very often, I mean often enough that you shouldn't use it. If it's ever happened to you that you put in a stop loss order and the market ran through your order and the exchange did not honor your stop loss order, you'll know exactly what I'm talking about. So you can go from a position where you're saying okay, I'll accept a 3% loss or a 2% loss. And then the market spikes down and suddenly you're at 4%, 5%, 6%, 10% loss or more, right? If you're in a long, for example, or the same thing if it goes to the upside and you're in a short. It happens all the time. And by all the time, I mean really all the time. It's not unusual for stop losses to not be honored. What is a stop loss? It's just a market order. It's an instant gratification market fill for which you're willing to pay a premium. It's just that you're placing that market order ahead of time, getting into the queue ahead of time, and hoping that the exchange will execute your order even if the market shoots through it. Well, what if it doesn't? Right? You're better off closing your position manually. That's why swing trading is also very dangerous. And walking away from your trading desk during an active trade is very dangerous because it can go very much the wrong way against you. So that's why it's important to remember, right, to take your profits early and often, limit your loss, which means get out of trades where you're not correct quickly, right, where it's going against you, get out ASAP, and don't be emotionally attached to your trades. Those are the three biggest things about trading that you need to know, more than anything else. Right? Yes, we have amazing calculators at Alpha Trading, right? A group that I co-founded. We have amazing calculators there, what you call indicators, right? Well, those indicators are calculators, right? What are they calculating? They're calculating volatility, entropy, probabilities, and statistics, right? And they're amazing, incredibly accurate, very powerful, leading information that let you stay ahead of the curve. They give you a quantitative edge over the rest of the traders in the market, in the retail space especially. So yes, those are powerful tools, but if you don't have good risk management, then you have nothing. And part of good risk management is knowing when to take profits, again, early and often, what to do when you're losing a trade, again, limit your loss, get out as quickly as possible, and how to manage the trade. Well, don't be emotionally attached to your trades. It's just a trade. You can always get in the next one. If you have to pull off a Band-Aid, it's a lot easier than trying to rip off a cast, if you know what I'm saying. So that's the whole thing, the whole kit and caboodle. Right now we're seeing a lot of assets moving up and down pretty nicely with volatility, right? Moving up and down very nicely, following the returns up and down very nicely on low time frames. You're getting a lot of moves to the upside, followed by moves to the downside. There is nothing unusual about this. What matters is that you're able to stomach it if it goes against you. And the best way you do that is by getting out of those losing trades as quickly as possible. And take your profits early and often. Don't just try to ride the bull because you think you're at a low and it goes up. What if you're at a low and it does go up and you think, oh, I'm just going to keep hanging on to it. It's going to keep going up. And then you have a big drop and it goes past your entry and you're suddenly in the red. Are you going to pull out immediately? Why didn't you take your profits when you're in the profits? You could always get back into the next trade, right? Like, you have to think, look, if you're not long-term investing, if you're short-term trading, right? And if you're using leverage, which is like, again, you got to be careful when you're doing that. Then, you're increasing your risk, right? By trading with leverage. So if you're in it for the short term and not for the investment, and you have more risk on the table, because look, as an investor, you can buy Bitcoin at whatever price it is. You're not going to get wrecked unless it literally goes to zero, in which case you can get all the Bitcoins for free, right? If you want, and then no problem. But because you're just buying it spot and holding it, right? But if you're actually putting on leverage to get it, then it's going to be a lot riskier, actually. It's going to be a lot riskier when it moves against you, even a hair. So the way to do that is to make sure that you manage that risk properly, which is why you're not looking for long-term trades. You shouldn't be sleeping on trades, like literally, right? You should be in and out quickly. And how long you're in and you're out, that's up to you. But low time frame trades give you more opportunities to exploit. So that's it for now, folks. Talk to you later. Peace.